Thanks for joining me on today's show. Today's episode is titled, What is Term Insurance? I haven't talked on the podcast much about life insurance recently. The last episode I think we did on this was back in season 3, episode 16, that was titled Why Women Need Life Insurance. Previous to that, we did an episode, Nobody Likes Life Insurance, which actually over the couple of years we've been doing the podcast, that is one of the most popular episodes, which is a little surprising. I wanted to go back specifically and talk about term insurance. To set the stage though, all of the research shows that Americans are dramatically underinsured and way too many people that need to have life insurance to protect loved ones, including spouses, children, business associates, or partners. It's a shame because term insurance, as we're going to talk about, is a very inexpensive proposition in most instances. So let's cover what is term insurance. There's two broad categories of life insurance. One is term insurance. The other is permanent insurance. Some of the types of permanent insurance I'll talk about in an upcoming episode, but it is whole life insurance, universal life insurance, variable life insurance, and there's a whole bunch of other fancy marketing policy names that would fall under the permanent category. Again, we're going to focus just on term insurance on this episode. Term insurance provides life insurance protection for a certain period of time. It could be any period, but what you see in the marketplace today is 5-year term, 10-year term, 15-year term, 20-year term, and 30-year term as the most popular. Most of what's marketed today and what most people have is something called level term, which means once you are approved through underwriting, which we're going to talk about, your premium and your death benefit are level through that term period. So if I sign up for 20-year term insurance and my premium is $500 a year for $500,000 of death benefit, I'm just making up those numbers by the way, that $500 a year premium and that $500,000 death benefit is fixed for the 20-year term insurance period. And that's how it works. It's very simple. The only way to get a payoff on the policy is to die, which is not really a great financial planning investment strategy, but you pay a premium and you have the insurance protection. This is very similar to car insurance and homeowners insurance. You pay a premium, you have the protection. Term insurance, unlike the permanent policies we'll talk about in an upcoming episode, term insurance does not have any cash buildup. You pay the premium, have the death benefit, that's it. It's not a supplemental retirement account. You cannot borrow against it. It is pure insurance. You can extend the insurance on a guaranteed basis at the end of the term. So if I sign up for 20-year term insurance, at the end of the 20 years, I am guaranteed to be able to renew that insurance. However, the new premium will be calculated based on my attained age. I'll be 20 years older, thus the premium will be higher because I will be older and I will be riskier at that point. So let's touch on underwriting for a moment. With life insurance, there is an approval process typically. There's instances where there's streamlined approval. Other times it's full underwriting, and this is especially true if you're dealing with a lot of insurance where the insurance company really wants to underwrite the risk carefully because of the size of the policy. Increasingly in today's environment, lower policy amounts, like $1 million and less, are streamlined underwriting, which allows a quicker turnaround. Now, we're still dealing with life insurance companies, so they're not the most nimble of companies, but it is getting better. Your premium will be based on your health, life expectancy, and underwriting of your medical records. Family history plays into it. height and weight. There's a whole bunch of things that the insurance carrier will consider once they begin underwriting. Once you're approved, they will let you know what your premium amount will be. And again, in the case of term, that is likely, if it's level term, which is the most prevalent thing in the marketplace today, that premium and death benefit will be locked in for the duration of the term. I prefer term for several reasons, and most of the work we do here at Elliott Wealth Management in helping our clients provide protection for their loved ones and in some instances for business purposes. I like term insurance because, as I said earlier, it's simple and it's inexpensive. You get a lot of bang for your buck, especially at younger ages, let's call it 55 and under. If you have life insurance, you're paying a premium, you have life insurance, tragically you pass away, your heirs would receive the death benefit tax-free. That's a really, really powerful part of life insurance. It is not just a feature of term. Any life insurance is going to be received tax-free unless it's in some exotic trust or something that is rarely seen, but I don't want to say always tax-free. But the vast, vast majority of the time, the death benefit's tax-free. That's a pretty powerful advantage to having life insurance. The rationale for buying term insurance is something that has been around as an adage for a long time, and that is buy term and invest the difference. The idea is for a family, let's say, husband and wife, couple of children, they need to protect one another so that if something happens to one of them, the other spouse brings in financial resources to help offset the loss of income and or to provide funds to help with the care of the children and the raising of the children now that one part of the marriage, unfortunately, is passed on. So if you have that need, by buying term insurance, you allocate a smallish amount of premium compared to permanent insurance, by the way, and you could get a lot of death benefit for a relatively small amount of money. Then that frees up the rest of your budget to build wealth with, to invest with, to pay down debt with. So you want to protect against the risk, and the term insurance does that. But if you could spend as little as possible for the most amount of death benefit, that frees up the rest of your money to carry on and build up your assets. And if you do this successfully, by the time you get to the end of the term, say 20 or 30 years, your financial picture as well as your life circumstance are likely to have changed dramatically. And if you invest and you play by all of the best guides for building wealth, the kind of stuff that I, as a certified financial planner, help my clients do, is you'll get to the end of the 20 and 30 year period and you may not need life insurance, or you may not need as much. Plus the children, who are originally a big part of the reason in lots of instances on why you want and need a lot of life insurance, once they get out of the nest and they're into their 20s and even beyond, their reliance on your income hopefully has gone away. So buy term, invest the difference. I am a big believer in that. I want to spend as little as possible to protect against the risk, and then that frees up other monies to build wealth with. You, again, with term insurance, get a lot of death benefit compared to permanent insurance, which is typically 10 to 20 times more expensive. Your premium is 10 to 20 times more expensive relative to a death benefit. Now, that's a generalization, but it's a pretty good rule of thumb. To be candid, Joelle and I, my wife and I, we only own term insurance, and that has been the case for a very long period of time since my children were very young. Actually, I probably have a life insurance term insurance policy that I had even before Marissa, my oldest, was born. And so I practiced what I preach. Most of the work we do for clients is we use term insurance. My view is it should be term insurance when we're tackling the life insurance topic, unless there is a specific an overriding reason why we should be using another type of life insurance policy. I'm not saying that permanent policies do not have their place, but term insurance in the majority of the cases is the better option in my opinion. I built my practice around that. It's what I've done in my own household. I want to talk about a couple of other slight variations on the term topic before talking about a few examples of when term insurance may not fit. But some other types of insurance, as I said earlier, these are rarer and rarer in today's marketplace, but they do merit a little bit of a mention. There's something called convertible term insurance, where you have the ability to convert your term insurance to permanent insurance at any time during the term period. And there are some instances where that has some advantages. I typically do not look for that feature in my term insurance because those convertible policies tend to be a little more expensive, but it is available out there. Another type is return of premium. That is, at the end of the term, the insurance company will refund to you 100% of the premiums paid. So if you paid $1,000 a year for 20 years, that's $20,000 in total premiums over the course of the term. At the end of the policy period, they will refund you the $20,000. Now that sounds fantastic, and it is pretty cool. But what do you think the insurance company does in those instances? They increase the premium compared to the non-return of premium versions of their policies. And so you're really paying extra to get the refund at the end. They're not the greatest bargains. I shy away from them. Although I do know I have a client I should say, that had gotten a return of premium policy, not from me, from someplace else a while ago. This month, they're getting a return of premium of $38,000. Now, I don't know if he got the best deal ever when he got the policy 20 years ago, but very happy to be getting that $38,000 check this month. So that's kind of a cool feature. The other one I wanted to mention is something called decreasing term, and it's also known as mortgage term. You see this less and less. It's not competitively priced, but sometimes when you get a mortgage, the mortgage company will try and sell you mortgage term insurance. And the benefit goes down as your mortgage goes down. So if you start out with a $250,000 mortgage, in 5 years, let's say that mortgage is $225,000, your death benefit declined from $250,000 to $225,000. I don't like those policies. They tend to be very expensive. They're kind of an impulse buy when people are crazy with buying a home and there's 9,000 things going on and they're signing a gazillion pieces of paper. It's not really a good deal. Unless you really can't get a life insurance, you can't get past underwriting, then it starts to be an appealing option. But generally, it's something to stay away from. Decreasing term is kind of play on that, where you may start out with $500,000 of insurance, but that declines over time. It's very rare today. Back at the beginning of my career, you saw more of that, but I don't think most people want to mess around with that. Level term seems to be the best in the vast majority of situations. Before we wrap up, let me just talk about some limits on when I would begin to look for something other than term insurance. One would be if an individual has a poor medical outlook, a bad family history. They're healthy enough now to get insurance, but the future is especially uncertain. Then getting permanent insurance, paying the extra premium may make sense. Still not a fan of those instances, and they're rare, but I would put that in the category of when I might consider an alternative to term insurance. Another is when you have an individual where they would like to throw a lot of money at life insurance and only pay premiums for a short period of time and then have coverage for their lifetime. And I did a case like this a few years ago where a young entrepreneur cashed out a significant amount of money with the sale of his business. And he had a wife, he had small children, and he said, "Chris, I would like to just pay for a short period of time while money is exceptionally good. I just want to get the life insurance done. I don't want to pay my whole life. I just want to check the box and be done. And what we did was a limited pay. It was 10-year permanent life insurance policy. It was a deviation from the norms, but it really met what he wanted to do, and we were able to carry out his goals and objectives in that way. The other two examples are in estate planning and long-term care. As you get older, you will not find term insurance to be as inexpensive, as much of a bargain as you did at younger ages. And sometimes when individuals get older, they look at life insurance for reasons other than family protection, like trying to protect a spouse and children, but rather for estate planning, to try and get money to the next generation, and to do that in a tax-efficient way. Because remember what I said before, life insurance is almost always received tax-free by their heirs. And what's happened too today is the life insurance industry has evolved and has a long-term care insurance feature in many policies where some of the death benefit, or even all of the death benefit, can be used if you need long-term care insurance to kick in to cover cost of being in a nursing home, in an assisted living facility, or even getting some type of care at home. And so older individuals, sometimes in the planning process, will look to life insurance to solve an estate planning issue and or a long-term care cost vulnerability, will look to permanent life insurance policies. But again, those are more special circumstances. Term insurance is the vast majority of what we do here at Elliott Wealth Management. And most of the ads you see on about get quote life insurance quote online, it's usually term insurance. So what is term insurance? We covered it. It's a great vehicle, especially at younger ages, 55 and younger, where you're trying to protect someone against a financial loss. Thanks for listening to this episode. I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meantime, subscribe to this podcast if you haven't already, please. I would really appreciate it. Additionally, recommend a friend, family member, coworker to check out the podcast. You could get more information about me and the team here at Elliott Wealth Management Services by going to our website, www.elliottwealth.com. Thanks again. I'll talk to you soon.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.